very pleased to welcome to Monetary Matters for the first time Neil Dutta, head of economics at Renaissance Macro Research. Neil is an economist who was one of the very few economists in 2023 to forecast that there would not be a recession, as there was not. And he was also one of the very few economists to predict that the Federal Reserve would cut by 50 basis points, 0.5%, instead of the much anticipated 25 basis points. Why is that? Is that because of weakness in the labor market? I am very pleased to be speaking to Neil Dutta. Neil, welcome to Monetary Matters. Tell us about this 50 basis point cut that we experienced last week. Why was it that you thought the Federal Reserve was going to, number one, should cut by 50 basis points, and number two, which is often a different question, actually would, which they did?
Well, thank you, Jack, for having me. I appreciate it. And first off, congrats on the new venture. It's tremendous. And I appreciate you having me on. So on the 50 basis point call, I think Powell basically greenlit that at Jackson Hole. And I think, there was a lot of sort of, if there was some doubt going up to the meeting or so forth. But, remember what he said. I think he was very clear. We do not welcome further cooling in the labor market. And after he said that, basically every labor market indicator that came out was worse than expected, whether that be job openings, the payroll data itself. People look at ADP. If you look at hiring intentions, some of the regional PMI employment indicators were weaker. So all of those metrics were kind of heading south. So I just said, it made sense to go big. At the same time, it was pretty clear that they goofed by not going in July, right? And you had to ask yourself, Powell's the one that actually gets up there and faces the firing squad of the financial press. And think about what he did, what happened in July, right? The Fed didn't do anything. At the press conference, Powell basically talked up the idea that they were thinking about cutting at that meeting. He mentioned that. They talked about it in the minutes that came out 3 weeks later. But remember what happened right after that meeting. You had a couple of crummy economic data points. You had a very weak ISM. You had a weak jobs number. Okay. Did they really want to go through that again, right? And obviously, after those two numbers came out, what happened? I mean, people were talking a lot about the yen carry trade, if you'll recall, but really, the markets moved after the data came out pretty weak. And that was fueling this sort of view on the street that the Fed was behind the curve, that they should have cut in July, and they didn't. Did they really want to do that again? Did they really want to go through, we thought about maybe going 50, but we decided on 25, only to have the data head south. And basically fueling additional bets on that the Fed is behind the curve. I think they wanted to avoid that situation, and of course the data itself was kind of lining up in that direction anyway. I mean, core inflation, if you look at the translation from CPI and producer prices to core PCE, it's basically going to be below 2% at an annual rate for 4 consecutive months, right? So basically every month since May has been below 2% sequentially annualized on core PCE. So not only do you have inflation cooperating, you also have the labor market slowing somewhat, not collapsing, but if you're waiting for the unemployment situation to collapse, or you're waiting for labor markets to collapse, you're waiting too long. So, I thought this was really about the Fed kind of playing catch up to where the data already was. And I think what's important about what they did is that they're basically putting the focus on the job market, that they're basically here to help. So if you thought of the Fed as sort of a management team and you think of the US economy as a company, what the Fed is basically doing is raising the bottom end of the earnings guidance, right? We're not out of the woods, but I do think they're clipping the left tail on growth risks. And I think that's a positive outcome.
Clipping the left tail on growth risks. And based on that, it makes me think, Neil, that you were in the camp that the Federal Reserve was not horribly behind the curve, but behind the curve. They should have cut interest rates in July, and they let the labor market weaken more than it should have. But it sounds like you think that there's a decent chance that they saved it just at the last moment. In other words, it's kind of like a action hero movie, and it looks bad, but they saved it just in the nick of time. But maybe if they did,
I don't think we're operating on that kind of like a knife edge, but I definitely think that look, I mean, all of this is sort of work in progress. I mean, there are lots of things that could happen between now and year end, between now and the middle of next year, of course. But I do think, maybe we'll look back on it and say, was the 50 to 25 debate really the whole ball game? Because I do think, they clipped the downside. Doesn't mean we're off to the races, but we do know if the data weakens a little bit more, like if you get like another, like let's say you get a clunker on jobs the way you did over the summer, like maybe 120,000, 115,000, slight uptick in the unemployment rate, the Fed will step right back in and do another 50, and maybe a signal to do even another 50 after that. So, I do think that backstop is important, right? I mean, so that's kind of a signal to the corporate sector that the Fed is going to try to stabilize demand. And if that's the case, the corporate sector, I think, would probably think twice about laying lots of people off. And so I think that's kind of where we're going with this. So if you're going to ask me, I mean, I think you have to be honest with yourself. I mean, I was very cautious going into that meeting, right? Because I said the risk was that they should go 50. I think they would go 50. I mean, because I assumed the Fed would do the right thing. And fortunately, that worked out. But ultimately, they did what I thought they should do. So of course, you have to sound a little bit more bullish on that, right? I mean, if they did 25, then I'd be sounding more cautious, right? But you have to be sort of intellectually honest and consistent. So I think, I thought that was an important debate. I think Powell kind of took command of the committee and did the right thing. And so I think that kind of puts us in a better place.
So this is good news, Neil. And this is things that if you're a journalist and people like bad news.
Well, I think, look, I don't, like I said, I don't think we're out of the woods. So there are negative things to talk about, but let's just take a step back and think about the bigger picture here, right? I mean, let's not sound sort of, put rose-colored glasses on, but let's just look at the facts of what's happened, right? The equity markets over the last 6 months are up about 10%, okay? Gas prices over the last 6 months are down about 10%. And the Federal Reserve is cutting interest rates, lowering borrowing costs for households and businesses. That doesn't exactly sound like a very terrible backdrop for the economy, right? Like, so we can talk about maybe some wobbles in the data here and there, but ultimately, remember we sort of went through that period in August where people were talking about, recession odds, they're going up. I mean, and I would always make the joke, recession odds are going up between basically July and the September FOMC meeting. And if they do the right thing, recession odds will go down, which is exactly what's happened. So, if the data crack and the Fed's thinking maybe we should only go 25, well, then that could fuel additional chatter on the downside. But, generally speaking, I don't think they're in a mood right now to take any chances. And really the first debate was 25 or 50. They came out on 50. I think Powell took command. And the next debate that they're going to have is how quickly do they want to get down to neutral? I mean, that's really the next debate. And, we'll see. I mean, to me, it's sort of, I can see a fairly easy path to around another, let's say 100 basis points worth of rate cuts. So that would probably take us down to 4%. But beyond that, it gets a little bit more dicey. I mean, there's political considerations, fiscal policy considerations. So, I kind of want to see how that all unfolds before I pass final judgment.
Mm-hmm. How much do you think cutting interest rates helps the economy now? On the one hand, you have the argument that cutting interest rates doesn't really matter that much. It could take income away from the economy. On the other hand, you're seeing articles such as the one we said, Bloomberg, U.S. companies are ready to borrow billions following interest rate cuts, and talking about how there could be $20 to $30 billion of borrowing over the next few weeks. But how much does that transfer to the labor market?
Well, I certainly think for certain types of products, right? I mean, consumer loans, rates will come down fairly quickly. Like as an example, auto loan rates have started to come down as the Fed's cut. Small business loan rates, those are based off prime loan rates, right? So those will probably start coming. Those have come down right away. And that'll help ease pressures, and that'll continue. I mean, we know fairly much it's a lock that the Fed's going to be cutting at each of its next two meetings. The only debate is how much they're cutting. So it's highly likely that rates in the sort of actual economy will be going down for things like autos and small business loans between now and year end. And I think that's probably a good thing. There are other areas where the progress is a little bit more uneven. Housing is a good example. I mean, for example, mortgage rates haven't really come down even as the Fed's cut. You've seen mortgage spreads come down, but longer term interest rates have been kind of hanging in there. They haven't really gone down as much. I think part of that is a function of people realizing that the Fed didn't make a mistake. Obviously, if the Fed went 25, for example, mortgage rates probably would have dropped a lot more because, people would have thought the Fed's behind the curve and 10-year yields would have declined. And then that would have brought mortgage rates down with it. But you probably would have seen a bigger decline in stock markets. So, I think that's I think what's important, one thing to keep an eye on, frankly, is just the mortgage spread. I mean, what is the spread between let's say a 30-year fixed rate mortgage and a 10-year, risk-free interest rate. And that spread appears to be narrowing, which frankly is what you'd expect given the ongoing normalization of the yield curve, right? Like, so the fact that the yield curve is steeper, I think that probably means that mortgage spreads will be somewhat tighter than they've been. Obviously, the spread has been historically wide. And you can also kind of see it based on, what you're seeing in the equity markets, right? So even though mortgage rates haven't declined as much, you've still seen, relatively good performance in things like home building stocks, for example. So, I think that's the market maybe saying that even though mortgage rates aren't down, maybe you kind of make a little bit up on the spread, but also, this is an economy that could probably, see some improvement in housing market activity, even with rates at, let's say a little under 6%. I mean, that's kind of where I think they're going. We'll see.
Neil, this is an argument, I encountered, I'm sure you've encountered over the past few years, that the Federal Reserve really doesn't have that much control over the economy because so much of the capital markets, so much of credit markets is the 10-year and the mortgage rate. But I really don't think that's true at all. I think that the most economically sensitive companies are borrowing at the SOFR, the short term, which the Federal Reserve completely controls. And, Apple is borrowing at 30 years or 50 years, but they're going to be fine no matter what. That's not economically sensitive.
I do think that it's sort of not well understood, but if you look at like decomposition exercises on longer term interest rates, like 10-year yields, sure, there are things like the budget deficit, demographics, foreign buying. I mean, these things matter a lot. But ultimately, what matters is monetary policy expectations. So what are 10-year yields? They're just expectations of future short-term yields. And so, and that's based on essentially monetary policy. So, I tend to agree with you. I think there is an element. I mean, obviously, the Fed doesn't have full control over these things, but in many cases, they move over expectations of policy changes. And keep in mind that it's not just the Fed, right? I mean, we're talking a lot about what's going on in the US, but if you look at some of the data that's been coming out globally, I mean, as an example, Europe, I know we're not going to spend much time talking about that, but just look at the PMI data that's been coming out of Europe. I mean, Germany's a mess. It looks like the core of Europe is in recession. You have very sluggish activity in the UK. But you can't rule out a scenario where the Europeans are doing jumbo rate cuts at some point before year end, right? Because their economy looks like it's weakening, pretty quickly.
I know that, so many people thought the ECB and the Bank of England would cut by a lot more than the Federal Reserve. But didn't the Bank of England just pause while the Federal Reserve cut 50 basis points?
I mean, they started a little bit sooner, so maybe that gives them the leeway to go more gradually. That may be what they're thinking. But as I say, ultimately, If you look, and in Europe in particular, growth is slowing pretty rapidly there. I mean, if you look at some of the PMI data that came out, it's not painting a particularly good picture for them. And so, and I say that only because if you have foreign central banks cutting more aggressively, that's going to obviously weigh on longer term interest rates here in the U.S. I mean, we saw that play out over and over and over again during the sort of sovereign debt crisis period, right? And in the 2010s, where basically moves out of the European Central Bank would weigh on fixed income markets here in the U.S. And I think something like that again is possible if you start to see more outsized moves overseas,
where foreign central banks cut interest rates, and that just brings dollar interest rates down as well.
Correct.
Yeah. So the last interview we did on my previous podcast, Forward Guidance, in late June, you said that you actually preferred bonds over stocks because you were worried about a recession. I did the math, and that was a good call. Bonds were up about 6%, where stocks were up about 4%. Bonds probably had less volatility than the stock market. So that's a good call. Are you ready to switch your call because you now you're more optimistic?
Yeah, I mean, I would take stocks here. I mean, I think if you ultimately, and I think we may have discussed this before, when you think about like potential economic outcomes, right? You have growth and inflation. So you either think that growth is going to be strong and inflation is going to be strong, sort of like an inflationary boom. You can have stagflation, right? You can have inflation strong, growth weak. You could have a classic recession, right? You can have, which is basically a deflationary bust, right? So negative growth and weak inflation. Or you can have, the sort of fabled soft landing, right? Which is, modest growth and benign inflation. Now, I don't think what we have today is like a pure soft landing, because in a typical soft landing, the unemployment rate doesn't go up as much as it has. So, I mean, you could make the argument, and I have some sympathy for it, which is, maybe we're somewhere between a soft landing and a recession. I mean, I wouldn't say it's an actual recession, but it's a situation where the economy is growing, but it's not necessarily enough to keep the unemployment rate from rising. But, ultimately, those are the four scenarios, right? And if I had to bet, I would say that the odds of soft landing at the margin have gone up since the Fed did what it did at their September meeting. And I think that trend will continue to remain in place. I think the Fed will continue to step in. So, in my mind, that increases the probabilities of a soft landing, which should be good for equity markets. And so if I had to pick stocks versus like 10-year notes, I would take stocks.
Given where inflation was so high, core PCE 5.5%, and it went down to 2.6%, 3-month annualized, it's below 2% now, so below the Fed's target. Given that near miraculous disinflation, the unemployment rate going up from 3.4% to 4.3%, obviously we don't want it to go up that much, and that rise often happens before a recession. But it is a pretty remarkable how much inflation has gone down without the unemployment rate going up. Yes, do you agree or no?
Yeah, I mean, if you just looked at the data as it is, I mean, 4.2% unemployment and basically core inflation below 2%, that's a very healthy economic outcome, particularly considering U.S. economic performance has been leading the world. I mean, if you look at real GDP. Mm-hmm. So we're in a pretty good place. A lot of these, things like the Somme rule, for example, which is triggered, you have to, I mean, what we know about the Somme rule, of course, is that it's perfectly sort of called all previous recessions. But what we also know about this COVID recession and recovery is that it was a very unusual one in its nature. And so you have to wonder about, whether some of these historical relationships are stable from one cycle to the next. And of course, one of the reasons why the Somme rule works as well as it does is because typically it's sort of it's catching that nonlinear risk in the labor market, right? Like, so the idea that once the unemployment rate goes up, it tends to reflect layoffs, and those tend to spiral on each other. What's been interesting about this, I think what's been to some extent interesting about what's gone on so far is that we haven't really seen a big increase in layoffs. What we have seen is kind of declines in job finding. And now I think that's bad enough. I mean, I don't think the Fed should really take any chances, but you've seen declines in the rate of job finding. You've seen declines in hiring rates. And the fact that the Fed wants to get out in front of layoffs turning, I think, is a welcome thing, because typically what happens is that companies reduce their recruiting intensity first, which is what's already happened, and then after that they begin to fire people. So the fact that the Fed's kind of stepping in before the firing, I think, is a welcome sign. But that could be one of the reasons why some of these relationships haven't held as neatly as they have in the past. What I try to explain in our client meetings is, think about unemployment as water in a bathtub, okay? And what we know about water in a bathtub is that if you can figure out how much water is flowing in from the faucet and how much water is draining out, you can figure out in the future what the level of water will be in the tub, okay? So now if you apply that that sort of logic to the labor market, you can do the same sort of thing with the unemployment rate and labor force flows, right? So what we know about the unemployment situation is that, thankfully, fortunately, the rate of water from the faucet isn't coming in any faster, right? I mean, that hasn't been turned up more, which is good.
Is unemployed workers.
Yes, exactly. You're not seeing more unemployed people falling into the tub. That's like a steady flow rate. What we do know, though, is that the water is draining out of the tub much more slowly, okay? In other words, those that have been recently unemployed are finding more difficulty getting new jobs. Job finding is going down. So the water is draining out of the tub more slowly, which means that the overall level of water, in this case unemployment, is still going up. That's why it's kind of happening at a more steady pace, you could say. I mean, you don't, like, the sort of increase in the unemployment rate that we've seen has been like, yes, it's been higher, but it's been like stable, in that sense, right? It hasn't been like an episodic, normally, like, you look at a chart of unemployment, it looks like a chart of credit spreads, right? It's just like it's an episodic increase and then it comes back down, right? You haven't really seen it this time, right? It's been sort of this steady upward drift. And I think part of that is a function of the kind of the nature of why, you've seen this increase in unemployment. It's really declines in job finding. Now, I think what the Fed is trying to do is basically stabilize expectations for future demand, which will, I would think, keep companies from firing lots of people.
Mm-hmm. So the unemployment rate, it had been marching steadily higher, but as you say, not in a nonlinear fashion. In August, though, what you referenced earlier, it did go from 4.1% to 4.3%. Now, I think the 4.1 was probably rounded down and the 4.3 was slightly rounded up. And then the following month, it went to 4.2%, right?
Correct.
Okay. So you're not worried about that apparent nonlinear jump from 4.1 to 4.2?
Well, I think that the unemployment rate, the bias for unemployment is probably still higher just because of the inertia that we have in the data, right? I mean, so the Fed just cut. You probably have a couple of reports where you're basically, those reports reflect like previous policy, right? Not necessarily what the Fed just did. Like, I mean, there are some kind of lags between these things. So I think the bias for the unemployment rate is probably still higher, but I think if that also prompts the Fed to step in and do more in a situation where inflation is remaining below 2, which I think will be the case, then it's hard to see it continuing to go up in perpetuity, right? I mean, eventually that'll probably stabilize, probably early next year. That would be my baseline expectation.
Stabilize early next year. What do you think of the summary of economic projections, but on the Federal Reserve's what they have for unemployment? I think the highest unemployment rate they have forecasted for the end of this year is 4.4, 4.5%. And for 2025, it's also 4.5% of the nearly 20 people who are writing these projections. Where's your projection for the unemployment rate, the end of this year and the end of 2025?
I'm actually not that far off from where they are at year end. I mean, I think 4.4, 4.5 is like a reasonable expectation. I mentioned that bathtub model that actually gets me to around 4.5 for the end of the year. The question is what happens next year? And obviously, the unemployment rate is not just going to march in place for 12 months. Okay. I mean, I think, you have to also put yourself in the shoes of policymakers. I know everyone always likes to like dunk on them. It's like sort of a parlor sport on Wall Street. Like, let's point out how stupid they all look. That doesn't necessarily mean that the people making those criticisms about the Fed are any smarter than they are, by the way. They may want you to think so, but that's not the case. But so it's unlikely that the unemployment rate stays flat for that long. But I would also say, if the Fed is easing and you do have private sector borrowing rates lower, and they're basically telling you that one of the most interesting things that we saw in the statement, Jack, was the phrase "maximum sustainable employment." They seek maximum sustainable employment. That's something that they added in that they didn't have before. What does that tell you about what they're trying to do here? So I wouldn't be surprised if the unemployment rate kind of creeps up, stabilizes, and by the second half of the year, the Fed's revising down their estimates for where the unemployment rate's going to land.
Rising down.
Yeah, I mean, I could see a scenario where the economy is growing, and some of this, maybe some of the immigration story is kind of fading, right? Like, and then the unemployment rate begins to go back down towards 4%.
Mm-hmm. And yeah, this is good news, Neil. This is great.
Yeah, I mean, I'm getting more optimistic on things. I mean, I don't see how you could not. I definitely reject the idea that the Fed is kind of like whistling past the graveyard. I think they're kind of more on top of things than people appreciate, at least for the Fed. I think, as I said, there are areas of the economy that I'm concerned about. I mean, the housing market is one, to be honest. I mean, if you look at particularly units under construction, so if you look at the level of housing starts versus the level of housing completions, I mean, starts are running way below completions, right? So that means that units under construction are going to remain weak. They're going to continue contracting, right? So the fact that particularly in multifamily, so the fact that starts are running below completions means that units under construction will come down. This could be one reason why job openings in the construction industry have come down quite a bit over the last couple of months, which could in turn weigh on construction employment, payroll employment, which has been one of the bright spots in the labor market. We talk about like the breadth of payroll growth kind of narrowing basically to healthcare, education, public sector. Construction has been in the private sector one of the notable bright spots, but that's something that could be at risk over the next few months because units under construction aren't really going anywhere. So that's something that's kind of concerning. And there's probably some potential for GDP to kind of catch down to other metrics, right? I mean, this is sort of like business economics kind of thinking, right? But you have GDP growing at like 3%, and you have total hours worked in the economy up, barely 0.5%. So if you take that all on its face, I mean, you're basically talking about, like 2.5% labor productivity growth. I think productivity is better, but I don't know if it's that strong. So you probably should see some convergence between these two things. And I think given some of the stuff that we're seeing in things like survey data, I mean, as an example, I mean, the Beige Book was quite weak the last time it was released, right? So it's not exactly consistent with an economy growing 3%. So there is probably some potential for some of these like GDP bean counting estimates to kind of come down somewhat between now and year end. But, again, I mean, this is really just like hiccups in the data. I mean, I don't think the overall story is changing. I mean, even in a good economy, you're going to get times when the data kind of slows to like 1%. It's like a soft patch and then kind of rebounds. And so that's kind of what I think could happen. But again, as I said, like the Fed has an itchy trigger finger right now, if that makes sense, right? I mean, they're not going to really tolerate much weakness. So if you do get some wobble in the economic data, I think we'll be right back here talking about another jumbo rate cut.
Yes, the verbiage coming out from the Fed officials today is that it's possible that another large, aka larger than 25 basis points, also known as a 50 basis point cut, could be on the table, but they're leaving it on the table. So further labor weakness, that means a 50 basis point cut could definitely.
So like again, the way to think about this really is that jumbo rate cuts are a call option on weak data. If you think the data is going to weaken between now and November, then they'll go another 50, and that's all I'm saying. Is it a collapse? No, but I think it'll be sufficiently weak that the Fed will want to kind of take no chances and do another large upfront move. And that makes sense given where they are relative to where they think neutral is. So, and that's part of what's going on here. So, but like I come back, I mean, I know it's not exciting. It's not as exciting as I was sounding earlier, but that's probably a more welcome backdrop for investors, I think.
She said neutral, that is the interest rate at which is neither stimulative nor contractionary. What do you think is neutral right now, and how far is the Federal Reserve at 5% from neutral?
Well, I don't think we're at neutral right now. I mean, because I think inflation's continuing to moderate, and so it's hard to say that you're at neutral if inflation is still falling below your target, which, by the way, it is. I mean, it may not be on a 12-month basis, but it is, over the last 3-4 months, and I think that'll probably continue to be the case at least through year end. Neutral is one of these things where whatever I tell you, that number is going to be wrong because it's a very abstract concept. You kind of know when you're there. But I think, 3.5% to 4% is probably where I'm at.
Is that higher than a lot of the Federal Reserve thinks, you think?
Well, the median on the Fed is around 3. So yes, it's higher.
Yeah. Why do you think it's higher?
I think we have a sort of steady demographic tailwind. We have a lot of housing that still needs to be built. We have strong consumer balance sheets. Obviously we have, you have to think about what are the reasons why neutral rates were so low in the first place, right? We had fiscal austerity. We had a lot of people saving up for retirement. A lot of those people, we had widening income inequality, and a lot of those, factors have kind of reversed, right? I mean, a lot of those people that were saving up for retirement have now since retired, and they're drawing down those savings. And that's all else equal pushes up neutral rates. Obviously, fiscal austerity is nowhere to be found. I mean, no one's talking about that. That was a huge constraint on growth in the 2010s period. So I think that those are a couple of the reasons why. And income inequality is another one. I think that's important because we have a sort of, a structurally more tight labor market, and that's generally speaking been pushing up the wages of lower sort of and service jobs, relative to what we saw in the previous cycle. Those people have a higher propensity to spend. And so I think that that's another reason to think that neutral rates are somewhat higher. But really, I think it comes down to, Jack, do you think the period following the financial crisis was normal or not? Okay. And I think that I think the financial crisis period is the period that was weird. That was the period that was abnormal. We had a lengthy period of household balance sheet repair, that kind of drove the savings rate basically from, 3% to like 7 or 8% for a period of several years. And I don't think that we're going to see anything like that this time. But generally speaking, I think that was the anomaly. So you have to ask yourself, if that was the anomaly, what was normal? What did normal look like? And it was probably what we saw before that, where, people would assume you have their Taylor rule. People would take the real rate as a given and they would just assume 2%. I don't think neutral rates, are that high, but they're certainly not 0.5%, which is kind of where it was in the period, following the financial crisis and that sort of new normal era that people were talking about back then. You had people with estimates of real rates as low as, 0 as high as 0.5. I mean, that was very unusual. I think it was just really a legacy of the asset and financial and banking deleveraging that we saw of that era. And now that that's largely run its course, you're probably going back to something that we saw in the period, following, in the early 2000s, like 1990s, where real rates, neutral rates were probably closer to 2%. Maybe not quite that high, but much closer to 2 than to 0.5.
So in the spring of next year, as the Federal Reserve, spring or summer of next year, as the Federal Reserve gets below 4% on its Fed funds rate, which is what's currently priced into now, it sounds like if you think the unemployment rate is going to go down, you think that that will be in the zone, that 3.5% to 4% zone of interest rates will no longer be weighing on the economy. What will you begin to be seeing in the economy that is going to be a beneficiary of that?
Credit sensitive areas. I mean, this is all what we're seeing, right? What the Fed is doing right now, I think, is basically trying to engineer a handoff. Like you mentioned earlier about the recession call of 2023, right? And I said that we wouldn't have one. And the reason I made that call, was basically because I saw that income growth was strong, right? We had falling inflation, labor markets were fine, so people were enjoying a tailwind to their real incomes, which supported consumer spending and kept recession risks at bay. That's become a more challenging call now because the labor markets have cooled, right? And so what the Fed's doing, I think, is basically trying to create a handoff from income-led growth to credit-led growth. So the areas that you want to keep an eye on to see if the Fed's policy is having the intended effect are things like household durables, like autos, right? Housing sales. I mean, that'll be an important one. Mm-hmm. So those are the areas. I mean, and then of course, capital spending, right? Business investment. And so those will be the three things that I'll be keeping an eye on. Really, it'll be consumer durables, autos, housing, and non-residential business equipment spending.
So in 2023, by saying no recession, you were leaning against interest rates because interest rates were quite contractionary. But you were saying, I don't think there's a recession because the labor market is strong. Now the labor market has softened, it has weakened, but because interest rates are coming down, that's what gives you confidence.
That's what it means to stick the landing. Yeah, they're creating that handoff.
So Powell is never going to come out and say inflation is whipped unless it's at like 1%. But you think inflation is largely whipped?
Well, I think for me, I have a very I do think that labor markets are important, and I think that that's an important, that's been an important source of the inflationary impulse on the economy. And one of the things that we see now is that unit labor costs are basically zero. I mean, if you pull up a chart of unit labor costs, it's barely up 0.5% against last year. So the way to look at that chart is just to see what it tells you about core inflation. And it's basically setting the table for much weaker core inflation from here. I think it's very important if you also do like bottoms up style analysis on inflation, right? We've had a pretty good few months for core inflation without, by the way, much cooperation from shelter, right? Like housing rents have kind of been all over the place. I mean, there's been a couple months where they've been looking like they were going to get better, then they kind of bumped higher. But that entire period, over these last number of months, core inflation has still been below 2% sequentially at an annual rate. And I think that's important because we probably have some more disinflation in the pipeline from housing rents. So if that starts to cooperate, you can see slower inflation. And of course, don't forget that we have lower gas prices over the last several weeks, lower diesel prices. That's going to bleed into things like grocery store bills, which will all get picked up in the CPI. So I think it won't just be actual inflation, but the way people feel about inflation should also be getting better over the next couple of months too, because the things that they buy frequently will be going down in price.
Does it worry you at all that often as the Federal Reserve, historically, often as the Federal Reserve has cut interest rates, that is when the recession starts?
Yeah, sure. It worries me. I mean, it means that you're not out of the woods, that the Fed tends to be, there's an institutional bias to be late. But, I think what Powell has shown is that he's not as predictable as many of his predecessors. Um, and, I've seen some people throw around like the 2007 analog already. I think it's kind of pathetic, but it is what it is, right? We had a strong GDP quarter in 2007, and the Fed cut 50 basis points, and they followed with a 25 basis point cut. And it wasn't until 2008 that everything fell apart. But if you look at credit markets during that period, they were in a much different place then than they are now. If you look at housing markets, they were in a much different place then than they are now. So I don't know that analog really applies. I also don't think that the 95, 96 analog really applies anymore either, because the unemployment rate's already gone up a lot more than it ever did during that period. You look at history, you pay attention to it, but I think one of the things that I try to tell our clients is that one of the biggest mistakes that you can make in macro is just assuming that relationships are stable from one cycle to the next. They're not. And so I think that's sort of the approach that I take. And, to me, I'm thinking about, you're always thinking about what are the potential downsides. But right now, as I mentioned earlier, we're talking about gas prices down, stocks up, and, we're still generating some job growth. We're seeing incomes growing. And we're in a situation where ongoing disinflation probably keeps the Fed on an easing track. These are all encouraging signs to kind of to lift economic prospects.
Yes. All things being equal, my opinion, all things being equal, low interest rates are stimulative. Now, often the reason that the Federal Reserve cuts rates is because something is wrong, and that's obviously not stimulative. But just all things being equal, low rates are stimulative. And
in this case, so what's interesting about this cutting so far is that you could say that it's a function of some things being wrong, but also other things being really right? Like, so, has the labor market deteriorated? Yes, it's deteriorated, right? Like job vacancies, the rate of job growth. These are all kind of flashing yellow. But what's been helpful is the inflation story, right? That's been the other reason. That's been the other driver of this, right? And so the Fed's cutting not just because of growth concerns. It's also cutting because they think the inflation story has been resolved, which they also mentioned in the statement. So it's not entirely a sort of this is end of cycle type dynamics.
Do you think that the rise in stock markets has been justified by the explosion higher in real GDP because inflation has fallen more than nominal growth?
Yeah, I think when I look at the underbelly of the equity markets, it's generally had a more defensive tone up until recently. And I thought that kind of made sense, right? Interest rates, generally speaking, were falling. That was probably lighting a fire under things like utility stocks, for example. That's like a very defensive kind of trade. I think going forward, I would probably be using opportunities to kind of layer into some more cyclically sensitive areas of the market. That's sort of how I'm thinking about it now. And obviously there's been this kind of like new economy type paradigm that's been trading in the equity market with AI and so forth. I don't really have a strong opinion on that, but my general view is that you probably see growth broaden out in 2025, and that should support equities generally, particularly cyclicals.
So you think the unemployment rate will go down? It can get much higher until the end of 2025, but around there, it'll actually start to go down. Do you think inflation will also continue to go down too?
I think inflation will probably keep going down between now and year end. We can talk about what happens in the middle of next year. But I think over the next 2 to 3 quarters, I think the overall trade for inflation is probably lower.
Got it. And so, Neil, we're recording Monday, September 23rd. This will come out Wednesday, September 25th. Between now and the next Federal Reserve meeting, which I believe is the day after the election, or actually, I think it begins the day after the election. The press conference is Tuesday after the election, I believe. What are the most salient economic data points that you will be obviously not only tracking, but predicting and in real time?
Well, we do get two jobs numbers between now and then, right? We get the, I think on October 4th, we get an employment report, and then we get another one on November 1st, basically the Friday before the meeting. So I think those are really going to be it. I mean, those are the two most important data points. I would also just keep an eye on like how the GDP tracking evolves. That's something that I'm paying attention to. I mean, I do think that there's probably some weakness ahead. Maybe you get a little bit weaker consumer spending, but generally speaking, I think the main story is going to be the employment data, and that's going to set the conversation for what happens at the Fed meeting. I do not believe that just because it's the week of the election, that means that they can't go 50. Like, I think a lot of these path dependency arguments have fallen apart now that the Fed's already moved, right? I mean, if anything, I think the election allows them to do more, because people won't even be paying attention to it. It'll be like, we'll be debating like who actually won the thing. And then, on page C1, it's like, oh, by the way, the Fed cut 50 basis points this week. So I almost think they could kind of get away with a jumbo move, because it won't be top of mind for most people. So they can kind of fly under the radar.
Yeah, I think you're right. I think that people outside of the financial community will not be paying that much attention to whether it was a 25 basis point or 50 basis point cut. Neil, what is something on your radar that is a black swan that you think is a risk that unlikely that it happens, but if it happens, it could get serious, and it's not something that most people are paying attention to?
I mean, some of the risks that we're already seeing. I mean, one is there's a strike at the ports. I mean, so then you have these supply chain things flaring up again. I see that Boeing is putting forward a 30% wage increase to end the strike. Does that bleed into other manufacturing industries? Mm-hmm. We have seen a very, very large increase in union pay relative to the pay of non-union workers. Is that kind of like another leg of the inflation story? That's something that I worry about. But those are the two most salient right now. Everyone always says geopolitical. I don't have any strong opinion on it. But that's obviously something to keep in mind. So those are sort of some of the risk things that I'm kind of keeping an eye on.
Thank you. And then my final question is just to clarify, earlier when you said that you were worried about housing, I think a decent percentage of our audience might hear that and said, Neil thinks housing prices are going to go down. Neil thinks there could be a credit bubble in housing. But what I think you meant is actually that just not enough houses are being built, and that could weigh on the entire economy because there are not going to be that many people being hired to build new houses. But actually, I mean, that could drive the prices of housing even higher, which is its own economic issue and perhaps crisis. But it's not an issue of the housing market being weak. It's that the housing market being too strong and there not being enough construction.
Yeah, I mean, there's a lot of like little things. I mean, remember, when you talk about housing to an economist, you're talking about residential investment. And residential investment is a three-pronged thing, okay? It's construction, it's broker commissions, basically sales, right? And it's housing renovations. Now, I think one part of that is going to be probably pretty sluggish. Maybe two parts. I mean, construction and home sales, right? I mean, if rates don't fall enough, I mean, you can continue to sort of see this lock-in effect that we've seen, which keeps prospective sellers with a lot of equity in their home from putting their home up for sale, right?
Right, but Neil, but that's been a big issue, and that's been a drag over the past 2 years. So it could continue to be a drag, but it will be less of a drag than it has been, right?
Yes, in theory. I mean, in theory, you should get some more sellers off the sidelines as rates come down. Yes. Mm-hmm. But on the flip side, right? I mean, you can easily come up with a scenario where renovation spending does a lot better because people are, let's say, locked into these homes. They've gotten a little bit decline in their rate. They have a lot of equity in their home. So maybe you see additional like sort of home equity lines of credit taken out, like equity withdrawal, and then they use that equity to go out and renovate their home, so to speak. So I think it's a more complicated picture, but certainly I don't see the kind of crash type dynamics and rapid growth in inventories that we saw in like 2006.
Thanks for clarifying. Neil, thanks so much for coming on, being the fourth guest of Monetary Matters. People can find Renaissance Macro Research on Twitter at RenMacLLC. Neil, just tell quickly the good people at home the types of things that people who, clients who subscribe to your research get, as well as to the other products of Renaissance Macro.
Oh, thanks, Jack. I appreciate that. So Renaissance Macro Research specializes in the core tenets of macro investing, which we think is economics, policy, and strategy. And we have products covering all of those different verticals to help you come at a better investment process. You can find us on LinkedIn. You can find us on Twitter at RenMac LLC.
Thanks, Neil, and thanks everyone for watching.